All right, everybody, welcome to the first lesson of the Master Lease Option Workshop. So this is going to be a little bit different than what we normally do. Typically, I just teach and tell you to download some documents and do some homework and move you forward. But I'm going to be a bit more involved on this one where you're going to be able to request some things from me. So hopefully it will help you move forward. As we go through and we do the agenda, you're going to see that these three lessons over the next 3 Saturdays, this Saturday and the next 2 Saturdays, they're going to stack on top of each other so that by the time we are done at the end of this, you should be able to enter the marketplace looking for master lease option opportunities, and specifically in markets that make sense. And that's really where the difference is going to be here, is how you're going to identify your market. Now, it's going to be a little different than what I teach in module 4 of the strategic partnering workshop, because in the strategic partnering workshop, we're looking for good markets. Well, for this strategy, we're looking for bad markets. So a little different. And I'm going to show you how to find those as we get into this. As a matter of fact, we're going to talk about that very, very shortly today. As usual, you guys can network with each other. I see your business partners jumping in, Bobby. Very, very good to see Bobby here. Bobby's had some health issues and he's still fighting them, but at least he's here and he's looking really good, and we're happy for that. And his business partner, Mr. Verisco, is jumping in now. We do have a couple of new faces. Raul's pretty new, Tammy's new, Furman's new. And some of you have been off and on in some of these. Welcome, everybody. All right, so let's get into the gist of this, of the Master Lease Option Workshop. I'm going to minimize my camera viewer, so I'll leave my camera on so you could still see me, but I can't see anybody else. If you have a question during this, just unmute and stop me and ask. This is interactive. I maybe even ask, matter of fact, I will be asking questions from you, especially when we jump into CoStar in a little bit, when we start talking about how to identify these markets. So if I'm going too fast, or if you have a question, just stop me, just unmute. Don't raise your hand because I probably won't see it. I do need to get the chat open, so let me pull the chat up right here. I'm going to close participants, so I have chat open. So I will try to monitor the chat, but you guys know that when I start get going and teaching, sometimes I don't see that chat. So that said, let's talk about the marketing plan. All right. So session 1, marketing plan, master lease option workshop. So what are we going to cover today? Well, we're going to go over the agenda for all 3 sessions today, next Saturday, and the following Saturday. Then we're going to determine how to identify a market. In this case, we're not identifying good markets. We're actually identifying declining markets, because that's where this strategy works the best. And then how to find multifamily owners. So we'll actually go in and determine how, once you've identified a market or 3, then how do you actually find the owners? So we're going to talk about that. And that's where I'm going to be participating with you. So a little different than what I normally do. I'm actually going to participate with you on this so that you'll be able to request some information that I will provide to you, which will be my part of this. Then we'll go into the homework, what you need to download, what you need to request, and then we'll have a Q&A session at the end. So the overall training session today should only last about an hour. Then we'll talk about the homework, and then I'm sure Q&A will probably last 30 minutes or so. So look to be here about an hour and a half today, would be my guess. Okay. All right. So the agenda, you've already probably seen this, but it helps to show it again. Today, we're going to talk about the marketing plan, how to identify your market and find owners willing to enter into that master lease option agreement. Next week, we are going to go into negotiations. So at the end of this, part of your homework, I'm going to have you download my marketing plan that I use to find off-market opportunities. Do not use it the way it exists at this point, because it is for 50 plus units. We're actually looking for less than 50 units in this strategy. So we're going to need to modify that marketing plan. That's what we're going to do next week when we start talking about how to negotiate a no money down deal for a master lease option opportunity. We're actually going to modify the marketing plan and the email marketing sequence that you can download after today's lesson. And by the end of session 2, you will have a completed marketing plan and a completed email automation sequence. All right. So that's why I said these lessons cascade into each other. And then in session 3, we'll talk about how to exit the master lease option and own the asset with seller financing with no private investors or partners, giving you maximum cash flow. So there are things you need to know in between. That's where the strategic partnering workshop comes in. So you're going to need to know how to do due diligence. You're going to need to know how to underwrite and all those other things that go along with doing a transaction. So you're going to need the strategic partnering workshop to complement this. There just isn't enough time in 3 Saturdays to put in underwriting and due diligence and everything else. As you guys know, that would be a whole nother 4 to 6 week course. And we just can't do that in a 3-week period. So utilize the strategic partnering workshop to complement the master lease option workshop. This is different material than the strategic partnering workshop, and where they complement each other, you can go to the strategic partnering workshop to get that information. So that's the agenda. So let's talk about how to identify a market. Now, a lot of you have seen some of this, but we're going to twist it where we're not looking for a good market. We're looking for a declining market. So first, you need to find a market that is in or heading into the recession phase. There are a couple of ways to do this. So you can use Dr. Muller's market cycle reports. And if you haven't noticed, if you've been hiding under a rock and haven't been paying attention to the Facebook group, the public Facebook group, we don't have a private one, or the strategic partnering community in Mighty Networks, although I don't post all the time in there. I posted it very early on. Or your email, because I send it out every time I do one, or I send about 2 emails a week on it with really big markets, and that is my YouTube channel. So right now we're at 35 videos in the YouTube channel, and we're going to jump into both Dr. Muller Cycle Market Report and my YouTube channel in just a minute. But first, let's discuss how to identify a declining market. So you guys have all seen the bell curve for market cycles. We start in recovery. That's phase 1. As we start to come up, we go across our long-term, that really should say occupancy average, not vacancy, but same thing, just inverse of each other. So we have our long-term occupancy average here. This vertical line represents your net operating income. So as rents increase, if rents are increasing more than expenses, then your NOI grows. And as vacancy begins to decrease and occupancy increase, that means we have more renters in our apartment at the same expense. So that drives our NOI up. Okay. So this vertical line is NOI. This horizontal line is our long-term occupancy. And market cycles are based and built on occupancy. That is how you determine demand and supply. So occupancy is the key ingredient to this. And a lot of people don't understand that. And I'm going to show you in Dr. Muller's explanation of how he looks at these market cycles, where he talks about occupancy being that number 1 indicator. Okay. So as we start to come up, we are declining in vacancy, we're increasing in occupancy, but we may have negative rent growth still happening in recovery. As we get across into expansion, we start into accelerated occupancy increase, accelerated vacancy decrease, and now we're in rent growth, and we start to enter into an accelerated rent growth. So rent growth being year over year. You can have rent declines quarter over quarter, which is what I display in the videos that I've been doing. But when you look at the market cycle chart, you're looking at rent growth on a year-over-year basis. I've gone into and determined that we should be looking at it quarter over quarter as we start to get into this oversupply phase. But once we get into annual rent growth of year over year positivity, now we're starting to go into expansion. And Dr. Muller takes it a step further, and he even says that if your inflation is, let's say 6, 7, 8%, then your rent growth should be above that number. If it's below inflation, then that could put you into the recession phase if you've gotten below that long-term occupancy average. So he's looking at not just rents themselves year over year, he's also looking at where they are in accordance with inflation, as well as what the occupancy is. So that's how he determines where he puts it on the market cycle chart. I do it slightly different because I go quarter over quarter, and I don't really look at where rents are in accordance with inflation to make that determination. So he looks at more factors than I do, but it's all based on supply principles. As we continue here, we start new development. So our NOI is high enough to do new development. Initially, NOI is only going to be high enough to do new development for Class A apartments. And we saw that in about 2013 through about 2017. Starting in about 2018, we started to see new construction because the rents were now high enough for Class B apartments. So we really didn't need to produce executive high-end apartments. We could start building to Class B because we had high enough rents. So now we can deliver on the Class B side, and we've seen that in all the markets I've looked at in my video series. There have been more deliveries to the Bs in 2022 than there have to the As. And that's because the rents are high enough that you can build to a B class, and you don't have to go to those higher end amenities because you could still get enough rent to be able to give the developer a profit on the project. Once we get past equilibrium, and all equilibrium is when supply and demand is equal. So once we get past that, we get into oversupply. So we still have properties under construction in the oversupply phase. There still will be rent over our year-over-year rent growth, but we are starting to see declines in the rents like we are quarter over quarter. And then once we get below this long-term occupancy average, now we're getting into year-over-year rent declines. We're below that inflationary period where our rent growth is lower than inflation, and that puts us into that recession phase. So this is how we look at and determine where we place on the market cycle chart. So here is the latest from Dr. Muller. This was the third quarter. He has not produced the fourth quarter yet. And his third quarter is not too far off of where I've been placing, although I've been placing them more on 0.13 than 12. I have put a couple of markets on 0.12. And I've even said, I did Fort Collins yesterday, and I said, and he doesn't have Fort Collins, he only does the top 54 markets. But I said that Fort Collins could potentially be placed on the equilibrium point, but I'm putting it here right now. We'll see what it looks like next quarter, but I may move it to equilibrium because Fort Collins seems to be holding strong and had an uptick in rents in the month of January. So very interesting what was going on in Fort Collins. But this is where Dr. Muller has placed 2/3 of the market in oversupply for the third quarter, and the lower point of the market in hyper supply, about a quarter of the markets. He's got 2 markets sitting on the long-term occupancy average, and a couple of the markets sitting at equilibrium. Nothing in expansion, nothing in recovery, and nothing in recession yet, sitting on that long-term occupancy average. Okay. So Phoenix, Phoenix was one of the worst markets I've seen, although I expected it to be worse than I saw. Let's see, Neil says, what specifically determines new construction Class A versus Class B? Neighborhood amenities, et cetera? Yes. The highest amenities packages that you can deliver will give it a Class A. You can deliver Class B units where you're not delivering stone countertops. Maybe you're delivering stone-looking countertops, and you don't have the highest level of amenity packages in the apartment. So that is what determines it, Neil. All right, so this is where he's placing everything, and you can download his latest report in the members area. But also, if I come out of here for a second and go, let's see here, I believe, yes, to the Burns School of Real Estate, I'm going to copy this and I'm going to paste it in the chat. That link takes you right to the Burns School of Real Estate at the University of Denver, where Dr. Muller works. If you go all the way to the bottom, just scroll all the way to the bottom to the footer and then come up one section. Here is where all the reports are. So he provides the lagging report. I say lagging because third quarter, we're now deep into the first quarter of 2023, and he's only got the third quarter of 2022 reported. So that's where I say lagging. So his lagging reports are free, or you could subscribe to his prediction. So he does a 12-month prediction every single quarter as well, but that costs. So the current reports are free. The future-looking reports are at a cost, and I don't know what the cost is. So this is available to you guys anytime. All right, let's go back to our presentation. Any questions about the market cycle itself? All right, so let's talk about the phases that are important to us for lease option. We have the oversupply phase and the recession phase. I call it oversupply. He calls it hypersupply. All right. So in the oversupply phase, that's what's known as the plateau phase. And I didn't make this stuff up. This is taught by the CCIM Institute, which they drew from the financial world when we talk about real estate market cycles. Okay. So in the plateau phase, we're in a period of decision, and we've kind of been here for a little bit now. So this is where demand and supply have an imbalance, and we can absolutely see that in every market we look at. Optimistic underwriting. You guys have all underwritten deals that are on this call right now, all 13 of you. Has anybody seen any optimistic underwriting or any unrealistic asset values?
All the time.
Every one you look at, right?
Absolutely.
Okay, so that's kind of what tells you where you are in the market cycle, right? Generous TIs. TIs mean tenant improvements. This is a commercial real estate term. In the residential world or the apartment world, you'd call this generous value add renovations. So this would be renovations, TIs. We're removing the obsolete and bringing it up to where it should be, and we're spending millions to do it. That's where that generous TIs comes in. Rent concessions. So you start to see rent concessions. Every single market I've looked at, all 35 of them, well, 34, one was the US, in my video series has shown that the asking rent is higher than the effective rent. What does that mean? That means there's concessions. So when you have concessions, it means that the supply is not strong enough where you can get those asking rents. So you have to offer concessions, a free month or 6 months at a reduced rate or free application fees or you have all these ors that you can concess in order to get somebody to sign a lease. And we are seeing a decrease in what they're collecting in rent than what they're asking. All right. That includes those concessions. And then, of course, high investment activity. We've seen a very high investment activity in the last few years. So what's our solution here? Well, it's time to dispose of non-core assets. What do I mean by that? Somebody tell me what the non-core assets are. No one wants to gander a guess.
I'm trying to think.
So if I'm a conventional apartment owner, and that is my focus, but I have a few properties that are mobile home parks, and I have a few properties that might be self-storage, and I even toyed with a triple net retail building. Where are my core assets? They're conventional apartments. So all the rest of those things that we've diversified, we need to start disposing of those non-core assets. We can also look, and it really should say, dispose of non-core assets and non-core markets. So if I'm focused in Texas, but I have some properties in Georgia, and I've got a couple in Florida, and maybe one in Columbus, Ohio, and one in Huntsville, Alabama, those are not my core markets. My core markets are in Texas. Now that wouldn't be me. I'm just giving an example because we have a lot of people that live in Texas in our community. So if Texas is my core market, I want to start disposing of those non-core assets, because when it's all said and done, when we hit that recession phase, we want to be able to focus only on those core assets and in those core markets. So hopefully we can survive through the recession. That's why we're disposing of these non-core assets. Does that make sense to everybody?
Yes.
Okay. We want to lock in long-term debt. I'm going to say that again. We want to lock in long-term debt. I didn't make this up. I know you guys have been hearing me say this for months. I did not make this up. This is an actual solution to being in the plateau phase. Have people been locking in long-term debt, or are they still buying bridge loans? I already know the answer to that. They're still buying bridge loans because they don't understand where they are in the cycle, or they have no idea what the solution is. And make no mistake, Brad Sumrock's been taught this because he is a CCIM. At least he was. I don't think he maintains his designation anymore. But he's been through this education. He has been taught this. He just doesn't teach his own people. You got to build third-party work. If you're a broker and transactions get fewer and fewer and fewer, which we are seeing, how are you going to supplement that income? If you're relying on commissions, you need to build third-party work. Okay, that's becoming a consultant or maybe become a coach or something like that. But you need something to get you through what's coming, which will be the next phase. Start accumulating cash. I've been telling most of you, I did an intensive last March on how to JV a 100-unit deal. Okay, and we talked about interest rates are rising now. We're going to be entering a recession phase. You're going to need cash. Don't collect that cash from investors, but you can start getting those soft commitments from them, or accumulate your own cash. Go do an opportunity that can get you an acquisition fee if you're doing strategic partnering, or if you're a broker, and then park that cash to the side so that you've got it as we enter the recession phase when opportunities start to come. And then, of course, downsize those non-core markets and those non-core assets. Okay, that's the plateau phase. That's where we've been. We are heading into the crisis phase. So now this is a period of change. There are declining rents. For the last 2 quarters, we have seen declining rents in almost every single market we've looked at. There have only been 3 or 4 markets, mostly in the upper Midwest and southern Florida, where we did not see declining rents. There's very little development going on at this point. Now, the development is slowing, meaning fewer and fewer starts. That's what they call somebody that applies for a permit. They call that a start. We're seeing fewer and fewer starts in these markets. So the development is finally slowing down. There's limited access to credit in this phase. We're not there yet. There still is credit availability, but when we get into the crisis phase or that recession, there will be limited, or could be limited, access to credit. It doesn't happen every recession, but especially in 08, you couldn't get a loan from the end of 08 till almost 2010. Loans were non-existent. You couldn't get one. You had to buy with cash. The only lenders that were loaning during that time period were insurance companies and life companies. They were only loaning to people that they had done business with, that they trusted, and were in core markets that they were interested in. Okay. At this point, we need to be deleveraging, because the higher leverage you have, the worse it's going to be, because as the NOI goes down and your value goes down, if you end up dropping below that debt service coverage ratio, you're going to be in a little bit of trouble. So you need to start deleveraging. That's where getting rid of those non-core assets will help. You've got declining asset values. You've got workouts and restructuring happen. Who knows what the big news was this week in the REIT world? Anybody see that? So Blackstone, the largest property REIT in the world, they own more properties than any other company worldwide. They don't own more multifamily properties. Greystar has that title, but Blackstone owns more properties, commercial real estate properties, than any other REIT in the world. They have entered or have hired or brought on, would be better, a receiver so that they can start restructuring their debt for their New York trophy properties. They have 11 multifamily properties in New York, over $1 billion in loans, CMBS loans, commercial mortgage-backed security loans. And they have asked for a receiver to come in, because when you bring in a receiver, you now have the opportunity to do workouts and restructuring. Until you get that special servicer, which once it goes into receivership, that's where a special servicer comes in. Once you've got that special servicer, you can now start doing that restructuring. When you just have your primary servicer and you're making your payments, which they are, then that lender isn't going to work out with you. So that's why if you bring in that receiver, it goes to a special servicer, they're allowed to do restructuring at that point. So even the top REIT in the world is struggling. If they're struggling, what do you think's happening in the syndication world? Another interesting thing has popped up, and those of you that know what's going on in Texas, there was a 5-property portfolio that was purchased in 2020, November of 2020. There was a guru that was one of the sponsors on that deal. They have recently done a capital call. There you go, Akash. They have recently done a capital call. And that capital call was to allow them, because their debt's coming due in November, and the lender has said, we want our money. We are not giving you your +1. And which I told everybody was going to happen. And so they've negotiated a settlement where if they bring in, now this was an $80 million transaction. I don't know how much the debt was on it, but you can guess that was probably somewhere around 65 million. They have negotiated a fee to be able to get a 1-year extension. So they have done a capital call with their investors in order to go another year. And when I got asked what that person should do, I said, do not give them any money. They cannot take away your principal. When they try to scare you and tell you that they will water down your investment, so you won't get as much. So if you were getting 7%, maybe now you're only getting 6.5% because you'll get watered down if you do not invest. Who cares? Because that group's in trouble, and they're probably going to lose the property anyway, because interest rates are going up. They're not going down. And a year from now, they're going to continue to be up. Yeah. Why would they, Akash? They can't take away your original capital. They must give that back to you. Now, if they fail and it goes back to the bank, well, I mean, that's, things happen. You do not want to give them any additional money. If you get a capital call right now, you guys are crazy to invest in a capital call because they're probably going to lose those assets. Anyway, it's already happening. Pay attention to what's going on in the marketplace. It's the only reason why I'm telling you guys this right now. But for the master lease option method, these are all good things. These are showing signs that there are going to be owners that are going to want to work out alternative solutions so that they can get rid of the stress that they have. And we'll talk about that later. But right now we're talking about market cycles. So what are our solutions for the recession phase? Buy. So once we get into the recession phase, we're going to need to wait a little bit. You don't want to jump right in, but now is the time to start acquiring those underperforming assets. That's what we're looking for. With the master lease option method, we are looking for underperforming assets, owners that are tired, that are stressed out, that don't want to deal with this anymore. And we're not going and looking for an $80 million deal, a 5-property portfolio. That's not what we're doing. We're focusing from 5 units up to about 50, depending on your market. Okay. Start acquiring necessity real estate and acquire market share, customer base, and talent. So even though we're in crisis phase, these are where the buying opportunities start. That's where most people fail, is they don't identify the buying opportunity and they wait until it gets close to that long-term occupancy average again through the recovery phase. And by then it's too late. All right. So this is where you want us. This is where Warren Buffett's buying. This is where Sam Zell is buying. Okay. They're buying in the recession phase, but you want to wait for a little bit. You don't want to start buying right away. So we got to give it some time. All right. Does that make sense? Questions on any of this? All right, good.
David, I got a quick question.
Yes. Go ahead, Bob.
Where do you find underperforming properties or owners who had enough?
We're going to talk about that.
Okay.
Yeah, we're going to talk about that. That's what this is all about. Necessity real estate goes right back to your core assets. That's your core asset, Susan. That's necessity real estate. It's just another way to say it. All right, so how do we identify a market? Well, here's what's different with this than any other workshop I've done. I want you guys to go in and look at the market cycle report from Dr. Muller, look at my YouTube videos, and I want you to choose a couple of markets, 1 to 3, that you can request the supply side reports from me. Okay. So, and I'm going to go in and show you how I do it here in just a second. So you can request your supply side snapshot and the rent analytics for all asset classes, including A, B, and C individually. And I'm going to throw in the MSA market report as well, so you can get a summary of what's going on in that market. All right. That way, now, once you have identified, okay, I've got some declining markets that are happening. These look like 1 to 3 markets I'd be interested in. Now you can start to interpret that data and plot it on that market cycle chart. So let's jump in to CoStar and take a look at that. All right. Somebody give me a metro statistical area that I haven't done yet, hopefully. Don't give me Dallas or frickin' Austin or any of those. I've already done these. Give me an MSA, maybe a smaller one that wouldn't be on the market cycle chart report for Dr. Muller, or one that I haven't done yet. First one to answer, that's the one we're going to look at.
Wichita Falls,
South Carolina.
All right, hold on. Say, what was the first one before South Carolina?
Wichita Falls, Texas.
Wichita Falls. All right, like frickin' Texas. Jesus Christ. You frickin' Texas people. Oh, that's not what I want anyway. All right, so we're going to look at the MSA data first. So this is what I do for my market cycle report, or for my rent analytic reports that I've been doing, my rental market reports. So I go in and I exclude all these, and then I only include market and market affordable. All right, and we're going to look at all 3 A, B, and C. Where to go? Right there. We're going to look at all three first. There really aren't any Fs. So I go to location, market. Let's see if Wichita Falls is even a market. It
Dave,
is. Yep.
where on the site can I find the model report?
I put the link right here. I put it
Okay.
in the chat. I'll put it in here again. And it's at the bottom of this page.
Okay, thank you.
And then it's also in Mighty Networks.
Okay.
I've already put it there. The
All right.
video, this video is not there yet, but your homework downloads are there already.
All right.
All right. So
Thank you.
let's go back to CoStar. There are only 85 properties in this market that are conventional apartments. So small market. So this is the supply snapshot. Once it comes up. So you get a picture of this. Your key here is this long-term occupancy average. So if I click all, we can see that the long-term occupancy average is at 88.3% or about 88.25, and it's sitting at 89.67. So it is over the long-term occupancy average. So we can already say that it's either going to be an expansion or it's going to be in oversupply, that it's not in recovery, it's not in recession, because we're over that long-term occupancy average. If we look up here, there are only 6,647 units in the market, nothing under construction, and people are moving out of the market. So in the last 12 months, people have left this market. More units went vacant than were rented. And it's increased from 9.1% to 10.3%. If you remember when I talked about the market cycle or the phases, that in the oversupply phase, we have increasing vacancy. Here, we definitely have increasing vacancy, and we have year-over-year rent growth. Well, we can see there is still year-over-year rent growth. So that pretty much confirms that this market would be in the oversupply phase, not quite in recession yet. All right. And I have not been looking at the capital markets because I don't really care about the capital markets right now. We're only looking at what's called the space market, right? Your capital market is the sales. The space market is the rents. And then we go over to data and we look at the data. Now, again, this is all three asset classes combined. And again, we look at only effective rent. Remember, I said you're going to have concessions starting to happen in that plateau phase, which is the oversupply phase. Look at our asking rent is $797, but we're only collecting $790. That means we have concessions. That's what that means. So we look at effective rent. It went up from $790 to $800 up to $813 and stabilized at $813. So, and it even ticked up to $818 in January. So kind of a little bit of a stable market here. We'll see what absorption shows us because there were nothing under construction, nothing delivered. Well, there may have been some deliveries. There's just nothing new under construction. So we can see that this market is slowing. And we've definitely had some negative absorption because the vacancy is increasing. So it's interesting that the rents aren't decreasing yet. But when you look at each one of the individual asset classes, we'll see. All right, so no deliveries as I suspected, and negative absorption in everything other than the third quarter. Okay, so this should show a rent decline, but that rent is plateauing. And it's interesting that it went up even though absorption was negative 35. So, and you're well below your long-term occupancy average at this point. Wait, what was the long-term occupancy average? Let's go back to summary. Oh, 88.25. So we're still above it. So because we're still above it, you could make the argument that the owners didn't just arbitrarily raise those rents. I'd argue they probably did, because you're sitting at 10% vacancy, and that's a pretty decent vacancy number. So right now you're just trying to get more rent, and they could be doing it because they're in trouble. That's another reason they could be trying to raise those rents. But the market is saying we're not paying these rents anymore. All right. So that's why we had negative absorption. Then I go and I look at the individual asset classes. So I'll pull this report for you. I can download it and export it and give it to you as it sits. That's how you interpret this data. So then if we just look at Class A, probably not going to be a whole lot of Class A properties in Wichita Falls. Yeah, only one. It's 172 units. So this isn't going to tell us other than one property. So it looks like they're continuing to increase rents. Let's see what their absorption is. Okay. Even though one person's moving out each quarter, they're still increasing rents every single quarter. So we're not seeing demand. And this owner is just raising rents because they can. Now, they're at 97.7. So I'd be raising rents too. Until I get this down to about 93%, I'm probably raising rents. So I can't blame the owner of this property for continuing to raise rents because their occupancy is still really stinking high. Again, this is only one property. It's a small market. So you're not going to take much from this data other than your only Class A property seems to be performing okay right now. So let's look at the Bs. And when we get into the Bs, of course, I'll pull that A report. Then I'll pull this B report. So there's 23 properties totaling 2,213 units. So some more data. Asking rents 881, effective rent 873. So there are concessions. Went up to 895, up to 904, and then down and down. So we have a break point between third and fourth quarter in Wichita Falls, right, where rents are now starting to decline, albeit a small decline, but they are declining. So if we come over, no deliveries, we can see that we're negative absorption overall over the last 12 months. And as with the A's, the third quarter was the only time there was positive absorption. And they are now down to that 93%. So I told you, owners like to get down to about 93%, and then they'll start declining those rents to keep the occupancy above 93%. What you don't want to do is ever let it drop below 90% because now you're limiting who can purchase the property because a lot of people like to use agency debt. So in order for them to qualify, they got to be above 90% occupancy. So, but they want to get down to about 93%, and then they'll start lowering those rents. So we're seeing that happen with the Class Bs. So rents are declining, not a year over year decline yet. If we look, we can still see that we had year over year growth of 4.1%. So we don't have that year over year decline, but we are starting to see that quarter over quarter decline. So again, confirming you're in that oversupply phase. So finally, let's look at the Cs and see how they're doing. My guess is we'll see negative absorption again in all four quarters, but probably have rising rents every single quarter would be my guess, because I've been seeing that a lot in the Sun Belt, especially in Texas. So looking at it, 770, 744, 748, 763, 760. Yeah, again, rising rents every single month. Let's see what occupancy looks like and absorption. Like I thought, negative absorption, albeit small. There are how many properties in this market? 58 properties totaling 4,200 units. So pretty small absorption, but negative absorption nonetheless, even though rents are increasing. And look at your occupancy. Your occupancy is below that long-term occupancy average and well below that 93%. So in this case, like we've seen a lot in the Southeast and in the Sun Belt, these owners are just arbitrarily raising rents because they think they can, even though the renters have said we can't afford them anymore. So this is an unethical situation happening in the Class C market in Wichita Falls, and you're going to start seeing those rents decline because 88% is too much. They're not going to continue to raise rents thinking they can get it when people are moving out, right? It's not sustainable. So we're going to start to see these rents come down with occupancy being this low, right? So that's how I look at this. So I'll pull that supply snapshot. I'll pull the overall data that you're looking at here, as well as the Class A, B, and C, right? Any questions on these reports or how to interpret them? Does everybody understand absorption? That is the key metric. Absorption is the key metric when plotting on our market cycle chart because it's what controls occupancy.
Yes, that was very clear, David. Thank you.
Good. All right. Awesome.
Hey, David, I got a quick question. So when does the COE come into play?
A what?
Is that before or after absorption?
A what?
Certificate of occupancy?
That's a delivery. That's a delivery.
That's a delivery?
Yep.
Okay.
No, this was a small market. We didn't see that. So somebody give me a larger market. Let me show you what some deliveries look like. Let me change
Kansas
my
City.
filter. All right, I'll pull Kansas. I haven't pulled Kansas City yet, so we'll pull Kansas City. It's coming up though in a couple of weeks. Let's go to location, market, get rid of Wichita. That way you can kind of see what deliveries looks like and how properties absorb from those deliveries and how it affects occupancy and how it affects rents. So we'll let this come up. We'll start at summary again. All right. So 2,722 properties in the market, totaling 176,468 units. Still have 7,300 under construction, and absorption has slowed considerably. Though in the last 12 months, 2,780 more apartments rented than went vacant. But in 2021, you had 7,500 more apartments rent than went vacant. And we did get an increase in vacancy from 6.8 to 7.7. So with units under construction, slowing absorption and vacancy rate increasing, that will kind of give us an idea that we're definitely on the left side or right side of the NOI line of the market cycle chart. We still have year over year rent growth. Looking at the long-term occupancy average, the market likes to be at about 91.5 and it's sitting about 92.25. So it is above that long-term occupancy average, putting it on that 0.13, if you will. I think it was that 1 point above the long-term occupancy average inside Oversupply. So if we go back to Dr. Muller's market cycle report. Oh, it's in the wrong. Oh, I haven't showed you the market cycle report yet. Let's see where he has Kansas City. So he's got Kansas City at equilibrium in third quarter. For fourth quarter, I'd place it right here in 0.13. So here's that long-term occupancy average. I'd put Kansas City right here. I'd probably put Wichita Falls at 0.12 and put Kansas City at 0.13. So we'll come back at that report here in a second. So that's kind of how you interpret this long-term occupancy average when you've got declining vacancy or increasing vacancy, slowing absorption, units still under construction, and still have year over year rent growth. But let's see what it looks like quarter over quarter. And we can see that it was at 1138, went up to 1184, and then that break point occurred between the second and third quarter. So we had declining rents in the third quarter, declining rents in the fourth quarter, and then we show an increase in rents in the first month of January. But let's see what those deliveries and absorption tells us. So you had 1,115 deliver to the market, brand new vacant. Okay, so that's what that means. They got their certificate of occupancy and they delivered 1,115 units vacant to the marketplace. Out of those 1,115, 1,871 absorbed. Those are big absorption numbers. Love it. Love absorption numbers like that. I like to see, in order to maintain a stabilized market, you need to be at 80% or more of deliveries. So obviously this is well above 100%. So that's good. Same thing happened in the third quarter. Another 805 delivered vacant to the marketplace and 1,521 absorbed. Now, keep in mind that we had 2,083 deliver in the fourth quarter of 2021 and only 808 absorbed. So these two quarters picked up that lack in absorption. Okay. So we've kind of equalized now between demand and supply at this point. So now another 1,015 deliver vacant to the market and only 612 absorb. Okay. Just a little over 50%. Then another 1,662 are delivered vacant and another 478 go vacant on top of that. So not a good absorption number, which is why we saw those declines in rents. And you can see that we went from 93% in the fourth quarter of 2021 in occupancy to 93.4 because we had more units absorbed than were delivered, and it shows it in the occupancy. Then the occupancy went up again because it happened again. Okay, more units absorbed than were delivered. And then it starts to tick down because now we're not keeping up with absorption. So occupancy starts to go down, went down a big number because we delivered a decent size number and lost more renters to the marketplace. And even though in the month of January, it ticked down again because only 418 units absorbed versus 757 delivered, the rents increased, which is a very interesting tale. Even though we're now approaching that long-term occupancy average. So that shows that that rental increase may not be accurate at this point. CoStar has said that the monthly data for January is ready and is available. I'd question that, considering that we started a rent decline and should have continued a rent decline because occupancy ticked down, not up. So that's interesting, but it probably tells us a story as to why that happened if we were to go look at all the A's, B's, and C's again, but we're not going to do that again. I just wanted to give you an idea of how the market reacts as units are being delivered. They're being absorbed either positively or negatively, and how it affects occupancy, and how it affects occupancy should also affect your rents, because this is showing that there is no demand in the third and fourth quarter, but there was strong demand in the first and second quarter. In the first and second quarter, we had an increase in rents, and in the third and fourth quarter, we had a decrease in rents. So those are demand supply fundamentals working the way they should. Does that make sense to everybody?
Yes, very helpful.
All right. Where are you going to get information like this from any other person?
Nowhere.
Yeah.
This is
Right?
invaluable.
I love this, David.
I don't know why people don't teach it. They either don't do it because they don't know it, or because they don't want you to know it. I don't know. It doesn't make sense to me. But anyway,
David, I got a quick question.
Yes, sir.
Maybe I don't understand the absorption part, but how can you absorb more than the units that were delivered?
Because there's still vacancy in the market. So
I got you.
we're only at 93.4.
Yeah.
So that means 6.6% are vacant. So we not only absorbed all of the new units, we also absorbed an additional almost 700 units that were currently vacant in the marketplace.
Yeah, I missed the percentage part.
And who's to say that all these Class A's were the ones that absorbed? And now the only way to know that is to actually go look at the Class A's. And it may not have been all Class A's that delivered. Well, let's look at B's, because we've been delivering more B's than we've been delivering A's. So let's look at the B's and see how the B's went in the first and second quarter. So you had 680, so about 50-50. So you had 686 that delivered and 970 absorbed. Same kind of number, 184 and then 770, and then that slowing occurred. So exactly how the overall reacted. So very similar. And we see this all across the country doing the same thing. The anomalies have been the C's. The C's are the ones that haven't been reacting appropriately to demand supply fundamentals. There have been a few markets that have. Kansas City is pretty close to the Midwest, and the Midwest is where we've been seeing the most accurate information as far as demand supply fundamentals. So we can see we got negative absorption, we got increasing occupancy. Of course, still fairly decent occupancy. What the rents do? Increase. Yeah, we're seeing this in all the markets. So it goes against demand supply fundamentals. But again, we're above the long-term occupancy average here. So you can argue that we need to go a little bit further down, but you're starting to reach that 93% point where below that, they will start declining those rents to try to keep it up above 93%. So kind of understandable of why it was increased rents. Does that answer your question, Bobby?
Yes, it does.
All right.
Thank
awesome. You. Okay. So that's how you interpret the data. So once you know that, now you can plot it on that market cycle chart. Okay. So now that we know how to identify a declining market, again, remember, we want to identify a market that is entering that recession phase, either in recession or entering recession. The two markets we looked at, neither one were quite entering yet. I would say it's entering the recession phase when that long-term occupancy average is sitting on that long-term occupancy line, maybe even just a little bit below it. And depending on how many units are in the marketplace, you can make a determination and say, if there's only, 300 units in the marketplace and it's sitting 0.5% below that long-term occupancy average, I'd call it in the recession phase. If there's 800,000 units in the marketplace and it's only sitting 0.5% below that long-term occupancy average, I'm probably calling it on the long-term occupancy average. All right. So you can make a judgment based on that. So once we've identified our market, now we got to start finding owners. So how do we find the owners? Well, we need property and ownership data. Where are we going to get that from?
CoStar.
Well, where could you go right now without having access to anything else? Where could you go get owner and property and ownership data? Can you guys make sure you're muted, please? I'm not asking a question.
He says, do not eat it. He says, he'll figure it out. If he takes a pill without
What
eating
is
it,
your thing, David?
So, or I'll mute you. There we go. No, strategic partnering community.
You're partnering, of course.
Yeah, strategic partnering labs. Go into labs, all the ownership data is there by MSA, every one of them. Now, here's what I want you guys to do. Once you've identified your market, I want you to tell me how many units you're looking for and whether you're looking for A, B, or C. I don't recommend looking for A. Probably not even B. You probably want to stick with C, but you may find some B opportunities that are under 50 units. Remember, we're looking 5 to 50 units. So tell me what you're out looking for. What are you comfortable doing? Remember, you don't have partners here. You're operating this thing by yourself with a property management company that you trust. You're going to have to hire a property management company. But initially, until you get that property management company hired, you're doing this on your own. So now you have me to support you, obviously. But what do you think you can handle? Can you handle 50 units on your own, or would you be more comfortable just handling 20 or maybe even 10 at first? So tell me how many number of units you're looking for and whether you're looking for all asset classes, just A, just B, or just C. And that will determine how I pull the data from CoStar. All right. So where can you get the data? You can get it from CoStar, Reonomy, Prospect Now, Land Vision. They all offer subscriptions. Or you just come to me and request the ownership and contact information, and I'll send it to you. So here's how I'm going to, well, let me get through this slide and then I'll show you how I'll send it to you. So obviously you're going to request the reports from me. Okay. And then once you get the reports, you're going to need to verify the information, because when we're under 50 units, Neil, don't tell me now, you're going to have to request it through an email. I'm not going to remember any request you make within chat. So send me an email on it. Verify the information on the owner reports that you receive. So how do you do that? Well, you can skip trace it. And you can either do that through your own software. And I demoed a software, and I'm going to show you again today, reiskip.com. It's actually a pretty cool software tool. If you've got the time and you want to do it on your own, and it does have a little expense to it, but I did 69 properties, and I think I ended up with 53 total results. And I paid $8 for it. So it's not expensive. It's only like, I don't know, 13 cents or 12 cents per lead that they find. If they don't find it, you don't get charged for it. So you can budget and say, well, if I've got 100 leads that I want to send through and it's 15 cents a lead, then I know it's going to cost me $15. So if you can afford that, we all here can afford that, then go ahead and throw it through REI Skip to verify the information. But it's also going to give you some additional information that CoStar is not going to give you, like email address. It'll give you some additional phone numbers and some other information that CoStar may not also provide, that is provided by public record. Because when you get under 50 units in CoStar, the data starts to get in a little sketchy. So we got to use Skip Trace software, especially in smaller markets. The other is to hire a virtual assistant. You can use Fiverr, onlinejobs.ph, which is the one I recommend, Upwork, and other VA software. Just go in, hire the VA. I teach how to do that in the strategic partnering community. I'm not going to go over how to hire a VA in this class. There isn't enough time to do it. We're already an hour into it, and I still got to show you how I pull the ownership data and how to use the Skip Trace software. So you can hire a virtual assistant. Again, that information on how to do that is inside the community. All right. And you can always ask, and I'll give you some ideas on how to do that. But you're going to want to skip trace the information. So we want to make sure we're not wasting our time. All right. So let's go look at CoStar again. And I want to go back to Wichita Falls, because there's going to be a butt ton of properties that are going to be available in CoStar, and I don't want to look at that, right? Or in Kansas City. So I'm going to go back to Wichita Falls. And 59 properties. Well, let's go back to our search criteria and get rid of Class C. Actually, you know what? I'm just going to do C. So we're just going to look at Class C properties. There's a total of 59 of them. So let's go to, whoops, I don't want reports. Hold on. Stand by. I hit the wrong button. I want to go to export. So you're going to get 2 files. Your first one is going to be the multifamily export. So it gets all this information about the property, about the owners, everything that I believe is important that you need. Okay, so I'm going to export that. So I hit export, and we're just going to come up here. I'm going to put that in downloads. We'll call this CoStar Export 1 and hit save, and we'll look at it in a second. And then I'm also going to pull one that I created for skip tracing called Skip Trace Info, and it only provides this information so it's easier to skip trace. But the amount of information you get from just this data is pretty stinking cool. So I'm also going to export this one, and I'm going to call this one CoStar Export 2. All right, so if we look at our CoStar export, and I'll let this pull up, take a second or two for it to pull up, probably going to pull up on my other screen. So give me a minute while this pulls up. All right, you guys have probably all seen this. So this is what the data looks like. Let me increase it so you can see it. So you got property address, property name, number of units. So star rating is kind of like building class. Notice the 2s or C's, some 3s or C's. You can even have some 3s that'll be C pluses or B minuses. So star ratings I really don't like. I pretty much go with building class for CoStar. Property type, secondary type, affordable, whether it's rent, subsidized or not, building status, market, submarket, city, state, zip, average unit size, average square foot, average asking rent per unit, last time it sold, what the price is, what the price per unit was, vacancy, year built, year renovated, number of stories, forget property ID, how many 1 beds, how many 2 beds, how many 3 beds, how many 4 beds, how many studios, average effective rent per square foot, average effective price per square foot, building operating expenses, county, for sale status, land acreage, land square foot, and all the way across to ownership data. So now we get into, so you have true owner and you have true owner contact. So here's a tip when you're looking at this. If the true owner name and true owner contact is the same person or same name, that's going to be a mom and pop. Okay. You can also, like this one, true owner contact is Deirdre Donadio. Anyway, and same with true owner name. That is a mom and pop. There's no LLC here. Same with this one. There's no LLC here. Okay. That is a mom and pop. You may even think, because Barge Properties, Bill Barge, may have created an LLC, this could potentially be a mom and pop. Okay. So you can kind of read into this. Brent Meyer, Meyer and Meyer Investments. Meyer and Meyer meaning husband and wife, mom and pop. Okay. That's kind of just a little Wayne Newman, Muhammad. Okay. Just a little tip there on how to pull out the mom and pops. I'm not telling you not to contact everybody, but that's a good way to pull out mom and pops. All right. Now, unfortunately, you're going to need to do some work to this. And if you go to the weekly Q&As, you'll find one of the weekly Q&A videos titled Skip Tracing Inside Mighty Networks. I explain exactly how to modify this spreadsheet, not this one, but the next one, how to modify the spreadsheet so that you can utilize it for the skip tracing software. So you're going to have to do some modification to this spreadsheet so that it will work appropriately inside. So now all we need is true owner name, true owner contact, true owner address. City, state, and zip needs to be exported out because we want just city, just state, just zip. And for owner contact, we want just first name, just last name. So you got to export those out to each other. And I explain exactly how to do that in that video. All right. And then of course the property address, number of units. So let me close this. Let me close this and show you what one looks like that we did. If I can find it, I didn't have the forethought to have this already up. So this would have been in maybe monthly marketing. No. Okay. Where would I have put this? Let's go to forms, tools, and checklists, marketing templates. Here it is. So here's what one of those lists looks like after you've made the changes. Come on. Okay, so first name, last name, address. It was city, state, zip. Now we have city, state, zip. I left it in there. I didn't have to. I could delete this if I wanted to make it cleaner. And then, of course, your property information. So, and again, city, state, zip. All right. And then number of units. So you need a clean like this, and you have to turn it into a CSV. So this is what it looks like. So what I did was I went into REI Skip, and it's free to sign up. It only cost to pull a skip trace. So here's the one I did, the multifamily owners, 5 to 50 units. I submitted 69. It found 54, and I can view that list. Okay. And this only cost me $8.60 something cents to get. So for 54 matches cost me $8 and change. So we can skip a trace to list, hit start, 15 cents a lead, unlimited. I guess my first one, it gave me for 12 cents. Beyond that, it's 15 cents. I've heard there are software out there that'll do 8 cents, 10 cents. Find one that works for you. This one was really easy to use. Upload new list, make it a name. I'm just going to put test here. And then you upload that CSV file. So if I go in, actually, let's cancel that and just drag that list here. If I just drag it right there, now I can map. Okay, so I got first name, so I find first name and I just put it in first name. Last name, property address, property city. That's just city. Property state is just state. Property zip is just zip. Mailing address, that is owner address. Owner city. Owner state. Owner zip. Okay, and then notes. So now if I want property name, I put that in notes. And for custom field, I put in number of units. Okay. So then once I've done all that, I hit next. It validates it. Here's all the information it found. Okay. And then I approve it. And now I can select, after your trace is complete, we'll send you a CSV file with all this information. So I only want to load the top 3. I don't want 10 phone numbers. I don't want to load all the owners, relatives, and all that information. You can do that if you want. I only just want the top 3 phone numbers and email addresses. So I hit next. And so my total price, if all 69 are found, is going to be $15.75. Now, I'm not going to do this because I already have the list. And so here is what it looks like when it's been skip traced. So I'm going to close this. So here's all the information you get. Talk about amazing. Oh. So first name, last name, their street address, the property address, their mailing address, where they're located, Alabama. Okay. Phone number type. Phone number type, phone number type, email 1, email, and he gives you up to 5 emails. Emails will become important to you. Okay. If they belong to a social network, what the network was, what their handle is. Okay. Does a few of those. And then some more ownership information, owner type, whether they're an individual or a company. That could be important information. There's primary owner, secondary owner. Here's loan to value and the mortgage. So a little extra information you didn't bargain for. Okay, got mortgage information. We also have tax information about the property. The last tax bill amount, year built, last time it sold, what its sell price was, who the seller was. So all kinds of great information that you get in addition to just that little bit of information that you provided. So well worth the $8 I spent for all this information. So I highly recommend using REI Skip. It was really good for me. And provided some pretty great details. Okay. So that's how, once I pull that information for you, that's how you use REI Skip. Go to that video in weekly Q&A. It says skip trace on it. It was done, I don't know, a month or so ago. And that will show you how to modify that Excel spreadsheet, or just go to Google or YouTube. And that's how I did it. And just type in how to separate cells in Excel. Okay.
David, I have a question for you.
Yeah.
Okay. And a cost X too, how accurate this is, and how up to date is my question also, because I remember when Bobby and I started in single family a few years back, we used a source called Real Flow to get information on properties, and it would have all the information, pictures of the condition and whatnot. And when we go visit the property, it was like totally different. It was, it would show us a property of a zombie house or something, and we get there and it was totally redone, bought, and a totally new place there.
Well, you got to
So-
remember that this software or any of these softwares are going back to the last time the data changed. So
Okay.
if the last person that bought the property and they've owned the property for 5 years, they've probably done some updates to it
Okay.
or not. So it's not going to know that current information. It's only going to know the last time there was a transaction
Copy that.
and what's current in the public record.
Yeah, David, what James is trying to say is that on Real Flow, it shows whatever the zombie house, and then when you get there, the house was actually knocked down and another house was rebuilt.
Yeah, that's funny.
That had to take at least a year to do.
Yeah,
Contracts,
possibly.
all that
I don't
stuff.
know anything about that software, and I can't speak to this software. What I do know is from everything I've been told, and from all the software I've used. Now, I didn't call any of these numbers. I didn't test the data out. Typically, you get about a 60% accuracy rate, but they're all that way. There isn't anything that's any better. When I was using CoStar, whether I use CoStar, whether I use Reonomy, and I tested all of them out, CoStar, Reonomy, Prospect Now, Land Vision, it didn't matter which one I used. It always seemed to be about 60% of the data was good.
And it makes sense that it updates based off the last transaction. That makes sense.
Hey, question, David. Within CoStar, do you have the option to select to determine how long someone has owned the property for?
Yeah, you can do that in a search. Yes.
Okay.
I'm not providing that service as part of this. I don't want to make this too complicated. We've got my time involved here as well. But if we go back to CoStar, and I go to my search filters, bum, 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 bum.
Don't they have it on the owner's contacts, Dave? On the owner's contact list when they purchase the property?
If it was disclosed. So here's origination information, maturity date, if it's a CMBS loan. Don't care about tenants, contacts. All right, so you can go back. You can go back to last sale date. So let's go up here. Let me. Building, rent, affordable, secondary, year built, land, property, features, year renovated, construction, zoning, We don't really want for sale. Exclusion, inclusion, days on market condition. Yeah, so you'll need to find comps where the last sale date and just go back to, and you could care less about the comps themselves. You're really just looking for properties that fell prior to, let's say, oops. Yeah, let's say 2018, January 1st, 2018. Where am I now? I'm in Wichita Falls, so it's a small market anyway, but 20 properties. So that means it was 58 properties, I believe, prior to that. So that means 20 out of 58 properties have traded hands since 2018. And here's that. Well, if we go back to map, there's that list of properties. Of course, now I can export that exactly the way I exported the other ones. Okay.
Got it. Thank you.
Yes, sir. All right, let's keep moving. So you don't have to use any kind of software. You can hire a virtual assistant to pull it for you. But you don't have control over the information they give you or what they charge you. The cheapest way to do it is to just use the software yourself. But again, your time is valuable. So keep that in mind. All right. So from this point, you want to start to create your marketing plan. So all I want you to do right now is just download the marketing plan that is in the members area. It's already been uploaded. You can go get it from Strategic Partnering Labs, or you can get it from where the recording is going to be on Monday, because that's typically when I put it up. I may put it up sooner. It depends on how busy I get. I got to do a passive investor conference at 1:30 today where I'm showing people how to find a market as a passive investor. So I'll be repeating a lot of this, only how to find a good market, not a bad market. So same but opposite. So you want to download my offline marketing plan and my automated email sequence. Okay. You're not going to do anything to it yet. You're just downloading it, because in the next session, we're going to modify it. All right. So that's what our goal is by the end of next session, is to have your marketing plan completed. Okay. But we got to talk about what to say to the owners first before we start to do that. So your homework is going to be to review the MSA rental market updates on YouTube and the Mueller report for third quarter. You're going to request up to 3 markets. So if you can, like for Neil's in Atlanta. Neil probably only lives or only needs Atlanta. And with, his W-2 and everything else, that's probably just a good market for him. If you can do your own market, do your own market. I always recommend try to stay in your local market. If you're in Southern California, that may be a little difficult. But again, we're only talking 5 units up to no more than 50 units. 10 to 20 is about the sweet spot for doing master lease option. So I'll give you the rent analytics and supply snapshot and the property and ownership information. And then you can take that data and go skip trace it, either using the skip tracing tool or hiring a virtual assistant. Okay. And then of course, download the marketing plan and the email campaign.